Exchange-traded funds, ETFs, are investment vehicles that provide exposure to a diversified basket of assets, such as stocks, bonds, commodities, or a combination thereof. ETFs are similar to mutual funds in that they pool money from multiple investors to purchase a portfolio of assets. However, ETFs trade like individual stocks on stock exchanges, making them more accessible and flexible for investors. ETFs have become increasingly popular over the past few decades as they offer several benefits to investors. Firstly, ETFs provide diversification by giving investors exposure to a broad range of assets in a single investment. This helps to reduce risk and volatility in the portfolio. Secondly, ETFs are generally more cost-effective than actively managed mutual funds, as they have lower expense ratios and trading costs. Additionally, ETFs offer the ability to trade throughout the day, whereas mutual funds only trade once a day at the end of the trading day. ETFs come in a variety of forms, including stock-based ETFs, bond-based ETFs, commodity-based ETFs, and those that track a specific index, such as the S&P 500. Stock-based ETFs invest in a basket of stocks, giving investors exposure to a broad range of companies. Bond-based ETFs invest in a basket of bonds, providing exposure to the fixed income market. Commodity-based ETFs invest in physical commodities or futures contracts for commodities, providing exposure to the commodity market. Index-based ETFs track a specific index, such as the S&P 500 or the Nasdaq. These ETFs are passively managed, meaning that they simply track the performance of the underlying index and do not actively manage the portfolio. This makes them a low-cost option for investors looking for exposure to a specific market or sector. When investing in ETFs, it is important to consider the underlying assets and the objective of the ETF. For example, if an investor is seeking income, they may look at bond-based ETFs. If an investor is seeking exposure to the technology sector, they may look at index-based ETFs that track the Nasdaq. Additionally, it is important to consider the expense ratio and other costs associated with the ETF, as these can have a significant impact on overall returns. In conclusion, ETFs offer a convenient and cost-effective way for investors to gain exposure to a variety of assets, including stocks, bonds, commodities, and specific market indices. As with any investment, it is important to carefully consider the objective and underlying assets of an ETF before making an investment decision.